Gentlemen, good day and welcome to the Aditya Birla SunLife Asset Management Limited Q2 and H1FY22 earnings conference call. We have with us today from the management Mr. A. Balasubramanian, Managing Director and CEO, Mr. Parag Joglekar, Chief Financial Officer, and Mr. Prakash Bhogle, Head of Investor Relations. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the management addresses conclude. Should you need any assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand over the conference to Mr. A. Balasubramanian for his opening remarks. Thank you, and over to you, sir.
Yeah. Thank you very much for the introduction, and good afternoon to all those present on the investor call. I hope you and all your family members are doing well. We welcome you all to our first earnings call following our recent IPO that we just concluded about 3 weeks back. Hope you all had the opportunity to go through the earnings presentation, which is available on stock exchanges and on our website. Let me begin by saying that we are overwhelmed with the response to a recent IPO and are thankful to all investors for trusting us and providing us an opportunity to be a long-term value generator. Just briefly talk about Indian economy and the mutual fund industry overview. We have crossed the 100 crores COVID-19 vaccination milestone, which has created confidence in the battle against COVID-19. The economy has been showing signs of recovery. We believe a further uptick in investor sentiment waiting to happen, supported by rising demand and improved financial performance in all sectors. The government impetus towards infrastructure spending and job creation is also expected to boost economic sentiment. Businesses are bracing for strong domestic demand as well as pickup in exports. Various institutions are revising India's GDP growth forecast upwards and believe that capital expenditure and an uptick in productivity will drive growth in the second half of this current financial year. Recently, the Reserve Bank of India retained India's GDP growth forecast at 9.5% for FY 2022. The IMF, World Bank, and S&P too are positive about a strong GDP growth for FY 22 and 23, with a forecast range of about 8 to 9.5%. Consumer demand, in fact, remains buoyant, and we are optimistic about the positive rub-off effect in business in the coming few months. In the last 12 months, the mutual fund industry witnessed new milestone on the back of strong growth in equity schemes, catapulting the assets under management to a record level of 3.62 trillion rupee, which is 36 lakh crore for the ending September 2021, as against 2.76 trillion for the quarter ending September 2020, a jump of 31%. Industry witnessed a strong net equity sales of rupees 8,200 crores in Q2 FY22, predominantly through new fund offerings and an existing fund. As on September 30, 2021, the total number of mutual fund investors stood at 113 million versus 94 million on September 30, 2020. In fact, new registration in SIPs over 7.55 million in Q2 FY22 gives us strength and confidence in the future growth of the industry. Average monthly SIPs flows have been around 9,200 crores for the last few months. However, in the month of September itself, it crossed 10,000 crores was invested through the SIP on the back of NFO launches. The retail investors' effect is also reflected in higher industry individual monthly average AUM, which grew by 41% year-on-year and contributed to around 54.5% of the total monthly average AUM. The new investors' fund flow was not just restricted to the top 30 cities, but is also strong in the beyond 30 cities too, on the back of rising awareness among retail investors. Overall, the mutual fund investment as on 30 September 2021 from these 30 cities was 16.5% of the overall assets under management. Coming to Aditya Birla SunLife AMC's performance, ABSL AMC journey has been very exciting over the last 25 years. Currently, we are the largest non-bank affiliated and the fourth largest AMC in the country, with an average assets under management of over 3 trillion rupee, a new milestone that we achieved in the current quarter. Our growth can be attributed to a variety of factors, such as broad spectrum of solutions offering in equity, fixed income, and hybrid funds that have been delivering consistent investment performance, strong presence across India, multi-channel distribution, and growing alternate assets. Our business is well positioned and our achievements are consistent due to a strong parentage and experienced management team working diligently for the growth of the company. Let me now take you through our key highlights for the quarter ending September 2020. We at ABSL AMC are focused on growing our overall assets under management across different asset categories. Our total average assets under management for the quarter ending September 2021 stood at 3,120 billion rupees, which is 3,12,000 crores assets under management, with a growth of 25% year on year, mainly on the back of robust contribution from equity segment. We maintain an overall market share of 9.15% excluding ETF. Our equity quarterly average assets under management grew by 41% year on year to 1,16,200 crores with 1,162 billion rupee, and our equity mix has increased to 39% as on 30 September 2021. Over the last 3 years, our focus has been on growing our retail franchisee and increasing the wallet share from the B30 cities. We are happy to share that our efforts have really worked well, with the contribution of retail franchisee increasing to 47% as on September 2021 compared to 41% 5 years ago. Similarly, the contribution from B30 cities has grown to 16% as of September 2021 from 13% 5 years ago. Our equity performance has seen a significant turnaround across all categories. While many of our focus funds across the market cap and hybrid categories have been consistent performers, the thematic fund from our umbrella and the new launches such as ABSL Special Opportunities Fund, ABSL ESG Fund, and ABSL Multi-Cap Funds have all delivered good performance since their inception. In our dynamic asset allocation strategy, which is the hybrid fund, we have seen AUM grow through net inflows driven by strong performance. While we have a pipeline of new funds awaiting to be launched in the form of NFO, we also remain focused on building our existing schemes across select large categories. On the back of our strong performance, our funds are also part of the organized channels recommendation list of late. We also have a strong distribution network of MFDs which have seen an increased activation and thus has contributed around 51% of our total assets under management equity is coming from mutual fund distributors from all parts of the country. All these factors put together will continue to fuel our growth momentum towards growing our equity assets further. Along with building our equity assets, on the fixed income side, we continue to enjoy the trust of large clients and individual investors across the country due to our investment management capabilities, across managing different duration within the fixed income space. We believe that as interest rates momentum picks up, there will be more opportunity in the fixed income space as well. In order to capture the early opportunities presented from the recent interest rate movement, we already launched and initiated few target maturity funds akin to FMPs, which we believe will help us further build our fixed income individual assets under management. Over the last few years, we have deep dived into building our retail franchisee by looking at markets inclusively and focusing on the productivity of each location such that every market can provide us incremental share both in equity as well as SIP. We have over 80% of our locations in the B30 market and continue to expand our emerging market presence by identifying newer locations. We also adopted the virtual relationship manager model and service to sales RM concept to bring in a hybrid approach to serve additional markets within India. Our 3-month pilot around the VRM model, which is virtual relationship model, has shown good results with the empowerment of around 1,000 IMFDs during the quarter. This brings in confidence that the hybrid model will help us in building further penetration in the emerging markets as well as B30 markets. Most of the retail franchise growth has come from SIP book growth. Our renewed focus on building our monthly SIP book size has helped us improve from rupees 811.7 crores per month to about 866 crores per month, coming from multiple locations across India. We have a long-term SIP book with more than 85% of our SIP registered for more than 5 years, bringing in stickiness of AUM more predictable. In order to popularize the SIP way of investing under the Har Ghar SIP concept, we have relaunched our Win with SIP campaign to create awareness about the multiple SIP or rather multi-SIP I call it, that eases the process of investing in multiple schemes. It also acts as an effective tool for goal-based investing as well. We have already seen some traction coming from this initiative. We have registered around 3,30,000 new SIPs during the quarter ending September 2021 as compared to 1,52,000 registration for the quarter ending September 2020. I am also happy to inform you that we have added 5,91,000 new folios in first half of FY22, and with this, the overall folio has increased to 7.3 million from 7.21 million customer base, which we had some time back. Our customer acquisition remains a key area of focus for us. Digital remains a key pillar of our growth story. We continue to collaborate with the early stage startups to remain ahead of the curve on one side and enhance our process efficiency on the other side. We have created an omni-channel experience by integrating API platforms in partnership with the fintech and digital partners. The distribution fintech partners contribute around 68,000 crores in industry average AUM, where we hold a healthy market share as of September 30, 2021. With these initiatives, we have onboarded 77% of new customers digitally. Currently, 84% of total overall transactions are done digitally, and 91% of our customers are now serviced via digital platform. We also empowered 91% of our new MFDs digitally in first half of FY 2022. We continue to deploy data analytics across our value chain to support our ongoing sales engagement for effective customer engagement. In terms of building our future capability, we have stepped up our alternate business by creating a differential product in passive, PMS, and AIF offering. To address the growing needs of HNIs and family offices, a dedicated team has been created to launch funds and reach out to potential customers and sell to existing channel partners as well as new age platforms. As part of our passive strategy, we are giving emphasis on smart beta passive strategies through ETF, fund of funds, and index funds. Passive AUM grew from 1,692 crores, that is 16,923 million in March 2021 to rupees 2,963 crores in September 2021. I can probably see in the last 6 months, the assets have doubled in their passive assets to where we are today, close to about 3,000 crores size that we are saying. On the PMS front, fundraising is underway for AF Category 3. India Equity Opportunity Fund is something we have launched under the Category 3 Fund Category 3 AF category. On the real estate front, we have signed a term sheet with the Bentel Green Oak and arm of SunLife International to jointly source and underwrite deals for real estate fund launched under the Category 2 Real Estate Fund AIF. In order to service the customers better, the needs of the global and NRI customers who are investing in India through our offshore business units, we are setting up a new IFC unit in GIFT City, which is Gujarat International Finance Tech City, very soon. We believe that our university education initiative will continue to educate existing as well as the next generation of investors and distributors and contribute to the overall financial inclusion. In addition to various activities that we are already undertaking in the area of education, we have recently created and launched an exclusive initiative. It's called For Her, aimed to financially educate women across India. As an AMC, we strongly believe that we can play a big role in promoting financial independence among women and spread the word on the importance of financial security for the future and emergency requirement of every woman in the country and abroad. We now move to financial for the quarter. Our focus continues to remain in achieving a robust asset mix of high margin assets of equity and long-term debt to improve revenue basis points to AUM. During the second quarter, total revenue has improved 28% year-on-year from 291 crores to 372 crores. Our profit before tax has increased 41% year-on-year from 163 crores for quarter ending September 2020 to 230 crores for quarter ending September 2021. Excluding other income, our core operating profit before tax for the quarter increased by 49% year-on-year from 128 crores to 190 crores. Our profit after tax has increased by 38% year-on-year from 123 crores to 173 crores. Our efforts on improving cost efficiency and productivity have resulted in a better operating leverage. there is a reduction in the cost to average assets and management basis points from 21.1 in the quarter FY 2021 to 18.7 basis points in the quarter 2 FY 22. Basically, the reduction of close to 3 basis points overall cost. While there is a reduction in basis points, it is to be noted the overall cost has increased in the Q2 FY22 by 12% year-on-year from 112 crores to 14 crores, mainly on account of employee cost and one-time IPO-related statutory expenses. Given the consistent dividend track record, we are able to maintain healthy ROE of 35.5% for the first half year of FY 2022 with an overall investment of rupees 1,958 crores being in the cash in the book as of now. With this, I would like to conclude and open the floor for any questions aimed at either me or my team, who is Ms. Paraj Ugale, who is CFO, as well as my other colleagues who are joining me in the call.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1 at this time. First question is on the line of Kunal Thanvi from Banyan Tree Advisors. Please go ahead.
Hi. Thanks for the opportunity and congratulations to team ABSL AMC for good set of numbers. So I had broadly 3 questions. One was on, when we look at ABSL, we have been seeing, market share loss for a time now, and wanted to know your thoughts on, what do you feel are the key reasons for, loss in the market share across the board and especially on the equity side. And the second thing was your company's philosophy in terms of, launch of new NFOs or, new products. Like, what are the key things that we look into when we come out with a new NFO? If you can share your thought process around that. And thirdly, on the debt side of the business, can you help us understand what kind of risk management practices we follow in the debt side? Because what we understand is in the credit side, last credit cycle, we've seen a lot of fallouts in terms of investing in bad papers. So wanted to understand what are the risk management practices that we follow at ABSL AMC. Yeah, that's it.
Thanks, Kunal, for setting the ball rolling on the Q&A section. Clearly, from the market shares point of view, what you just mentioned, yes, all the incumbent players in the last 1.5-2 years, especially post 2019 credit market crisis, the existing incumbent players were seeing somewhat of loss in market share, therefore giving way for other mutual fund players who are underwater in the system. They also started getting out of market share. In fact, in our case, while we have seen the overall market share declining last year, now we have stabilized the overall market share about 9.15%. What I mentioned is more or less getting stabilized in the overall scheme of thinking. And then equity too, now close to about 7% market share that we have. But also in our own belief is the decline that we have seen, probably will see that an improvement coming in on the basis of some of the new fund launches that we have. Second, on the back of strong performance, our funds are now coming as part of the recommendation list in the organized channel, and also focus that we are bringing on SAPs. All factors put together should only help in improving the overall market share. But having said that, I think we have been growing our absolute the AUM growth year after year. I think the numbers that we have seen that I mentioned about growth in overall AUM, both in fixed income and equity, that has come on the back of the absolute growth also is the focus that we have. At the same time, on the market share, which I am a firm believer that while the dominance of few players will always remain, I think we as a fund house have got more than 20 years of track record. That's essential from an investment management point of view. While we'll continue to keep a high focus on increasing our pie, I think market share is something, since there is mutual fund is actually also opening up for more players, probably there may be a stagnation in terms of market share. But at the same time, the absolute growth which you can grabbing the pie of the market, I think will remain a big area of focus for us, including adding customer base. With respect to your the second question on fund launches, while we as a fund house have been having a presence in every category of funds which has been defined by SEBI. In fact, I can take the liberty of telling you the reason, one of the reasons there is also a loss in market share is something that funds that couldn't be otherwise launched during the current market time or garnering really good assets is not possible given the fact we already have an existing presence. Therefore, some of the funds had the advantage of launching those funds which probably can consider the gap areas for them, which I believe that as over a period of time will get exhausted. So therefore, the existing funds have to be one of the funds through which I think everyone has to grow. We also believe in the same way. While doing that, we launched a fund this year in the month of April, multi-cap fund. We felt that new fund category, there is an opportunity for us to raise money. We launched a fund, multi-cap fund. In fact, the fund has done extremely well from April till date. The NAV close to about 13 rupees. That's something again, we collected close to about 2,000 crores. Last year, we identified opportunity to launch special opportunity fund as well as the ESG fund. Now we believe ESG fund will become part of the mainstream of fund itself for us to get regular flows, given the fact that sustainability theme is now becoming a theme that everyone has to follow. And now we have actually filed the offer of SEBI approval has already come. We intend to launch the fund sometime in the month of November, which is a business cycle fund. On the basis of our own internal analysis that we did under the PMS scheme, that market goes through every 3-4 years a cycle, where the sector got rotated. Therefore, one is able to actually apply that principle for construction of the portfolio. Then there is an opportunity for us to launch a business cycle fund. And that's something, again, we believe that we will take this to the NFO market sometime in the month of November. And that's something will help us in rising more market share as well as the AUM and customer base. But broadly, the new fund launches is only on the areas gap if we feel that they're relevant for the customers. And the sustainability of such product is going to be longer in terms of shelf life. Then we will actually take such kind of fund launches. Otherwise, the maximum component of our growth will come from the existing scheme. That's the way we plan. With respect to the third question on debt side, I think clearly we as a fund house have been a dominant player in the fixed income space for many number of years. Over a period of time, after seeing multiple cycles, we have put the risk management practice in such a manner, defining to the extent of what is the kind of exposure that one should take, both at the issuer level, as well as industry level, as well as the rating level, and what is objective of each of the schemes with respect to the duration management, the kind of credit portfolio that has to maintain. In all these parameters, we have very clearly defined what we call as binding condition for the money managers. That's something I think is driver overall risk management practices. As a result of that, during the current financial year, post the credit market crisis that we saw in 2019, in fact, we are one of the fund houses that grew our fixed income side as equally as the equity in order to have a larger size. So that is the way I think we build our both asset classes, having built the capability of managing both equity efficiently as well as fixed income efficiently. Risk management now has become a part and parcel of life itself. And hope it answered your question, Kunal.
Sure, thanks, Bala. That was really helpful. I'll get back to you. All this.
Thank you very much. Next question is on the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, sir. Congratulations on a great set of numbers. Just a couple of questions from my side. Firstly, if I look at the yield, they have been kind of flattish on a sequential basis, even YOY basis, there is slight improvement. This is in spite of our product mix moving so much towards equity. Why would so the movement in yield doesn't seem to be commensurate? So could you explain that, and how do you see the yields going ahead? Second question is on the B30 market share. While you highlighted that over the period of 5 years, we've seen a significant improvement in B30, but of late over the past 1 year, we've kind of seen some moderation in equity market share, in B30 market share. So now, while we had laid out a great strategy to improve the same in terms of diversification, in terms of widening our reach, how do you see the How do you see the market share panning going ahead?
Yeah, thanks, Prayesh. I'll of course ask my CFO Parag Jugli to answer the first question. To answer your second question on B30, clearly, Prayesh, we as a fund house had really more advantage of expanding our reach in smaller markets, including emerging market we call it, and create a presence for about 280 locations. That has been helping us in increasing the overall size coming from this market, both in terms of market share as well as the customer base that we have from these markets coming is also equally high as we have in 230 market. I think the recent drop in the market share that you may see, it has got nothing to do with our aggression is missing. It's more about some of the NFOs that came the last almost 1 year, especially in the current bull market, and most of the flows that has been raised, such as few large fund houses, which you all know, that also have got reasonably good collection, is coming from B30 market. Therefore, temporarily it got actually more towards a few other players. But at the same time, given the fact that we do have a specific strategy for the B30 market, and both in terms of creating our presence and what I mentioned about virtual RM model that we are creating for activating more IFAs and engagement of the banking channel with whom we have built a good relationship on the basis of our product being part of the recommendation list. We believe it's more of temporary, but our commitment and the brand recall that we have in each of the smaller markets, it would help us in maintaining a healthy market share coming from B30 market. This is handed over to Parag to give you an answer on your revenue question.
Yeah, hi Prayesh.
Hi.
As you rightly mentioned, the increase in the contribution on the revenue side year on year, you can see a jump from 42.4 to around 44 basis, which is a healthy jump which we have seen on the back of changing AUM mix as well as the growth in the AUM. Against the last quarter to this quarter, the contribution has remained more or less flattish. Basically, because it is the equity AUM has also remained to greater extent in the same range, and even the overall equity AUM has a various components of various schemes. So, basis which scheme you get money, what kind of AUM and what kind of scheme you are into, that will drive the economies or the contribution to the overall revenue. But with the revenue is on the healthy 44 basis, which we will continue currently, and we see it once the favorable mix of the asset comes in, it will further strengthen.
Okay. Yeah, thanks for that. This is the last question on the cross sell. We at the time of IPO we've spoken a lot about the cross sell. Any incremental information that you would like to share on the cross sell strategy that we are doing, and how do you see the traction there?
Yeah. See, Prayesh, I think there are two things that we are doing here. One, the existing customers, our 1.3 million customers that we have, how they can actually buy that incremental product that we can do from the point of view of buying. Therefore, we have a ratio about 1.57 of the 5 that we have for customer folios. And we intend to increase it further. That's something we are seeing reasonably good traction. With respect to the cross sales, we did a pilot project last about 3 months back. Of course, I've seen some kind of progress in terms of adding the cross sales are close to about 700 crores and coming from about 28,000 investors. And that's something we are seeing good progress that we are making. Of course, cross and upsells, as you know, a lot of learning is there from the point of view of how customers react and then how customers are willing to get converted into buying our product in the ongoing current market environment. That's something we keep doing a course correction. Therefore, the effort is actually keep progressing on that. Take advantage of the large pool of customer base that we have as a group.
Okay. All right. Thank you so much.
Yeah, thanks.
Thank you very much. Next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, thank you very much for the opportunity. Good afternoon, everyone. Bala, the first question is on the cost efficiencies. Our cost continues to trend down as percentage of AUM, 18.7 basis points in this quarter as well. Can you give us a flavor of where these costs can go, or maybe what is the flexibility we have on the cost term for the next couple of years? And within that, also the second part is what kind of ESOP expenses we should be building in for this year and the next year?
Yeah. Anu, thanks for this question. Of course, I'll invite Parag to give you the answer on the ESOP. See, broadly on the cost, as we have been highlighting for quite some time, we will try and work towards one, keeping the absolute cost under control, and second, we'll also try and work towards improving the productivity. Therefore, we're able to get the operating leverage. That's something also is helping. As I said in my initial remark, while the absolute number has gone up marginally in the overall cost, but basis points has come down thanks to the operating leverage benefit that we get. I think that will remain one of the key areas of focus. Only one or two areas where we may probably see not a basis points increase, but absolute number increasing, because once the economy get opened up, people start traveling a little bit here and there. Therefore, such expenditure which are more essential from the business point of view, they would get probably incurred. But not something which is, I would assume, I need to worry about it. With respect to the ESOP, I'll ask Parag to answer the question.
So Anuj, the ESOP cost for the current half year is around 24.5 crore. And as you know, that ESOP is a standard plan. So over the period, this cost will go down as the vesting happens and the vesting schedule is. So the current half year, it is 24.5 crore.
And sir, can you remind us what is the vesting period for the ESOP plan?
It's a 4-year plan, and it has a different vesting period according to the type of ESOP, because we have the RSU and the normal ESOP. So accordingly, the vesting period is 2 years. Some of them are vesting in every year. So accordingly, the hit will be, but it is over the 4-year period.
Okay, understood. And lastly, you have announced a dividend, interim dividend as well in this quarter. So can you give us some color on what is the dividend strategy for the full year on a sustainable basis? Some of the peers have communicated 50% is the minimum level for them, the payout ratio. Do we have something in mind on that as well?
Yeah, thanks, Anuj, for asking the question. During the roadshow, when we were discussing about our distribution policy and dividend, clearly we were indicating anywhere between 40 to 50% would be the range in which we'll have the minimum dividend that will be declared. In fact, the dividend that we have declared today, it is exactly equal to 50% of the first half year profit. That we want to just showcase to the investors that yes, what we have mentioned, that we are remaining committed to that. On the basis of its interim dividend we are given, and probably could expect that becomes the base policy, if not better, from the future dividend distribution point of view.
Understood. Thank you. Thank you very much, sir.
Thank you very much. Next question is from the line of Dipanjan Ghosh from Kotak. Please go ahead.
Hi, sir. Good afternoon. Just two questions from my side. One is, I saw in the presentation that you are launching some thematic-based ETFs and smart beta ETFs which are there in the pipeline. So just wanted to get some sense of, what are the profitability of these products and, what is the revenue yields that you will charge. Secondly, what are the key differentiators? I mean, almost all the, players we see today in the market and some of the emerging ones, almost all of them are planning to come up with this sort of product. So how to differentiate between these products is going to be on the distribution side, and what are the key competencies that, we as a company have. Second is more of a number-related question.
Repeat the second question, no? First question I understood. Second question, just repeat.
Second is, if you see some of these products on the ETF side, almost all the players out there, or even some of the newer ones that are coming into the market, almost all of them are coming up with similar sort of products on the passive side. So what will be the right to win on these products? Is it distribution, or is there going to be some differentiation? And what we as a company really have the competencies to kind of emerge as a winner in this segment. Third, just a number keeping question. If you could just break up your revenues for the quarter and on YOY basis into core revenues and the net gain on fair value change.
I'll ask Bharat to take the last question first, then I'll answer the other two questions.
So Dipanjan, just to give on the revenue side, you can see our revenue as a bits has gone, or the as a absolute number has gone from 255 crore of the last quarter same period to 332 crore in the current quarter. Against last quarter of June, from 303 we are 332 in the current quarter. The bits has grown from 42 basis in the September quarter last year to 44 basis in the current quarter. The last quarter of June had a similar range of 44 basis. So as you know that it is driven mainly by the high profit margin asset, which is equity. So equity mix remain more or less healthy around 38%. So we can see that the bits to overall contribution remain more or less same or increasing once the bits or the equity mix goes up. On the other income, you can see our other income, which is the on the treasury income is 40 crore again compared to 33 crore of the last quarter and 35 crore of the last year same quarter.
Okay, sure.
Yeah. So with respect to your Dipanjan for your first two questions, see the ETF the way we are building is one, the products that are more what you call routine or maybe traditional like Nifty 50, Nifty ETF kind of things. So those will remain. Those will be of more 20 basis points kind of ETF. That's something which will have as a complementary product to the other product that we have. While doing that, we also been simultaneously launching a smart beta ETF product. Recently we did one which is called Nifty 50 Equal Weight Index, where I kept the expenses at 1%. The same way we have launched a few funds that are more, we are planning to launch, that have got some of the quant-based ETF that can potentially outperform the market on the base of the past track record that these indexes have been generating. Such kind of product will actually look at operating anywhere between 40 to 50 basis points kind of expenses. So that is the broad setup that we have. Ultimate idea from the ETF point of view, the collective of the basket, which should aim to get anywhere between 40 to 50 basis points kind of range that we should aim at. That's the way we have been building it. And hopefully I think we'll be able to establish that as we start moving and start building a size. At this point of time, we are not looking at expenses, we are just looking at creating a basket. Once it is done in terms of differentiation, the way internationally firms like BlackRock has built globally, we believe one, ETF will remain a complementary product to every customer. And second, we as a mutual fund have got a duty to give every product profile that is most suited for him. At the same time, help him construct a portfolio comprising actively managed funds and passive managed funds. That's why we believe that having both things will work. And second is, on the basis of the institutional customers who also need some differentiated product, our effort will be to have this product also being part of the offer list as we move forward. And that's something we believe that we bring in some differentiation. But as you might know that one or two funds will of course have somewhat of advantage because the government backed the inflows that comes only to few funds. I believe the way I think the government is also moving towards encouraging more private sector mutual funds to come in. Once it gets opened up, that share of pie will also be made available from others, though of course too early call to take. But definitely I would assume as and when it comes, we'll also be ready to grab that share.
Sure. Thanks for the detailed response. Just one follow-up. The different question. If I look at your MFT base, that has been going up a bit over the last few quarters. But can you shed some light? Has there been an increase in activation rates, or you are focusing a lot on increasing our wallet share across the MFTs? Has there, quantitatively, has that gone up, or can you shed some light on that?
Sure. See, the mutual fund distributors as a fund house have been working very closely, shoulder to shoulder for many number of years. In fact, we have created many programs which are more in the nature of caring for our mutual fund distributors in the form of privilege club initiatives that we call it. Many such initiatives have actually increased the bonding with them, at the same time ensuring that we give the best experience possible to all such investors who have come to MFDs. So in fact, there are two agendas that we keep. One, look at the market share of every MFD that we have to deal with them, as to what is the deserving market share that should have on the basis of that our funds are performing, or maybe funds are relevant. And second is activating such IFAs by encouraging them actually come into SIPs on a continuous basis. That's something we do. And third is identify those markets where the MFDs need some kind of support in the form of education and knowledge, and then we drive it through a distribution engagement program and enhance the knowledge of distributors. Therefore, they are able to actually gain more knowledge, and as a result of that, they are able to help more customers. As a result of that, we also actually get the benefit on their activation. That's the broad strategy we do. Only thing that what we have done, Dipanji, is we have now made this part of our day-to-day system rather than business as usual kind of thing. That is helping us to actually have the engagement program quite continuous 360 days, which in our own belief is will help in having a more share from this segment. At the same time, get new mutual fund distributors from a smaller market. Therefore, they are able to build economic model for themselves to serve more customers, as well as work with a fund house like us in increasing their wallet share.
Sure. Thank you. Thank you, and all the best.
Yeah. Thanks, Dipanji.
Thank you very much. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Next question is from the line of Aditya Jain from Citigroup. Please go ahead.
Thank you. Just on the cross-sell, if I understood correctly, you mentioned 28,000 customers have been acquired through the cross-sell program. Based on the experience so far, how would you frame the total target of cross-sell within AB Capital that you see possible within 1 or 2 years? And related to this, so is it right to interpret this as the total new folios which have been added in 1H, which is about 0.6 million? So 28,000 out of that. So we are talking about maybe 4 to 5% of new folio addition having come from the cross-sell program. Is that the right way to look at it?
Yeah, I think, Aditya, thanks for this question. See, the target that we have, roughly about 5 lakh customers we identified on the basis of analysis of those customers of ABC who could potentially be a mutual fund investors. So out of the 5 lakh is the one where we started the pilot program, and that's, I think, given a conversion of roughly about 28,000, about 5-6 crores gross is coming in. See, one of the things that we identified is really we started with one product. We believe that one product probably may not be the right solution to the customers. We need to give them a variety of 2-3 products, and also ensure that the communication that we have for such kind of customers also has to be more sharper in order to ensure that we have more conversion. So therefore, that's something in my view next 1 or 2 years on the basis of the learning that we have. Also, I think a separate team of people who have been driving it at the capital level. We have recently had somebody comes with rich experience of doing a cross-sell upsells from HDFC Bank, and hopefully that individual bringing in new insight also will help us adding more customers from this initiative. From the 0.6 million customer base that you mentioned about, the 6 lakh folio that we added, clearly I think within the AMC, while the 28% of course the 5%, naturally we will have faster growth even adding more customer base on our own basis, irrespective of whatever happens in the cross-sell upsells. So therefore, it's very difficult to put any absolute number. Given the fact that the customer outreach that we have to create independent of what other companies will do, will remain one of the big area of focus. Therefore, in my own view, both will continue to progress, but percentage is something we'll have to see it over a period of time.
Got it. Thank you. And on the mix within equity, so in response to an early question on the lack of increase in yield despite increase in share of equity, you had commented about the mix within equity. So is there some target of large cap, mid cap, multi, or broader equity mix that you have in mind that you would like to achieve?
Yeah. Clearly, Aditya, the way we do is, in fact, if you deep dive into our equity portfolio is about close to about 1,27,000 crores. In that, arbitrage fund will be about 9,000 crores. and then rest of the funds are all pure actively managed equity funds. In fact, we are the fourth largest fund in the large cap category. We are again fourth largest fund in the flex cap category. The same way, Birla Advantage Fund, which is again which is the large and mid cap category. Again, we are the fourth or fifth largest fund. Clearly, I think we keep the target in each fund. We need to be a leader. Each category we need to be a leader. That's why we every time look at growing our existing fund size, and that's something we will continue to keep a big focus area. In fact, our own belief is any customer when he puts money, he'll put about 60 to 60% of his money in the actively managed funds covering large cap, large and mid cap, and flexi cap, and actively managed balance fund category, and also catering to the thematic funds. And we as a fund house, 24% of our fund size coming from thematic category, which also believe has got a huge opportunity for us to grow in size, given the fact that we have a good performance backing coming in that segment as well. So therefore, that's the way we approach Aditya in terms of building our equity. Then we actually go and approach the organized channel to ensure that each of the funds which have got a great track record to be recognized as part of the organized channel and come to the part of the recommendation list. Therefore, we are able to build after it get recommended to a reasonably good size. Even SAP also we build on the same way. Therefore, that's something we do it very systematically, and that makes us believe that we will see the improvement coming in these funds as we move forward.
All right, sir. Thank you.
Thank you very much. Next question is from the line of Sahej Mittal from HDFC Securities. Please go ahead.
Good evening, everyone. Thanks for the opportunity. My question was on the passive side. Just wanted to understand, what percentage of our passive side folios are as a percentage of, active folios. The reason why I'm asking this question is to understand that what percentage of our active equity fund holders are also holding a passive scheme, are also holding some sort of funds in the passive scheme, and is there how likely is it that they can move their funds going into the future towards the passive scheme? Yeah.
Sure. Thanks, Sahej, for this question. See, if you look at the current the industry level, out of about 36 lakh crore size, roughly about 3 lakh crore is the ETF. And within that, if you see the maximum component of that, roughly about 80% of the 3 lakh crore is come from EPFO, government-related mandate. Therefore, you would knock the top, and the rest of the pie only is available for rest of the players. Which in my view, at this point of time, very insignificant in the overall context. But having said that, more and more awareness is also coming for an ETF. Probably this size of the rest of the market will also start growing. The way I see at this point of time, probably though right now is very insignificant overall component, the way I see is 10 to 15% of the overall asset management could potentially become coming from the passive. And given the fact that large component of Indian investors prefer actively managed funds, and also we keep advocating that Indian equity market will provide a great opportunity to the investors for generating alpha. And since we are still developing market, and that's been the case, an ETF I would assume over a period of time 10 to 15% could come from that segment, though it's too early to take the call, but that's the direction in which probably it can move. And one more point, Sahej, I'll also like to mention. See, as the size of the fund keeps rising, in the existing actively managed funds, we must also note that with the glide path has been defined by regulation. With the higher the size, the expenses will also get moderated. That being the case, unlike in US market, the differential between ETF and this will not be as alarming as somebody has to worry about it. And that is being the case, I think the large component will come from active, and the rest of them, like I mentioned earlier, will come from the passive as a category.
Thank you for a detailed answer, sir. That'd be all from me.
Yeah, thanks, Rajesh.
Thank you. Next question is from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity again. Just a follow-up on the yields that you spoke about on the ETF side, that on basket. So this will be the expense that will be charging to the scheme, the 40 to 50 basis points, or it will be the flow to the AMC?
Yeah, Parag.
So, Prayesh, it is currently we are just very small in the ETF, but over the period, the passive as the index and the ETF put together, we are the overall pie may look at 40 odd basis, and the fees will be maybe depending on 20-25 basis, depending on how it pan out. But currently it is very small. But
Okay.
that is the idea, that over the period we will build the size and the revenue from that.
So in fact, Prayesh, right now, of course, we'll be incurring only cost on that one. We have to launch product and we have to promote it. And though we will target that 40 to 50 basis points kind of expenses, given the size, given the fact that the size will keep building and also keep building our capability in terms of even back-end operational ease that we can create. The one such thing we have done, we have tied up with a small case to give the back-end seamless operation, and also intend to offer a product which is more the portfolio kind of approach that we also intend to have. Also, think we'll have some initial investment that we have to keep making. And as the size becomes bigger, the broad thought process that we had, 40 to 50 basis points, something which we will target.
Okay. Thanks for that. And so lastly, if you look at the recent NFOs, the fees or the commissions that were shared were significantly higher, and so that's something which the market has been witnessing for the last in the recent past only. Do you think that kind of trajectory will continue, where NFOs will be at a much higher expense ratio or a much for the industry overall?
Yeah, I think the way it works is, I think NFO is something which helps in one, getting new assets on one side, and other side getting new customer base so that we are able to onboard more and more new customers. At the same time, the first year generally is actually the years it doesn't give that much of profit. Though broadly on a 2 to 3 years scale, the way we work, about 60 to 65% should be the normal distribution commission, and 35 to 40% would be the management fees. That's the broad model in which it settles down. See, any NFOs that we did then, first year generally we have to assume that it will not add much to the profit. As long as there is no profit, no loss basis, but at the same time helps in improving the overall pie, the longer term benefit that can accrue to that would be much, much higher. So that is the way I think normally NFO works. I think I would assume that same model will exist in general for the industry.
Okay. All right. Thank you so much, sir.
Thank you very much. Next question is from the line of Nidesh Jain from Investec. Please go ahead.
Thanks for the opportunity, sir. Can you speak about the digital partnership? How much of our AUM coming from them? What are the key trends? And you also spoke about the size of the that particular segment for the entire industry. If you can just rehash that number, that would be useful, sir.
Sure. Nidesh, we did see one. We do have ties with all the RIA platform as well as the distribution platform such as Zerodha or PhonePe and all such platforms we have. And identified about 70 to such platforms who at this point of time matter from the point of view of their own credibility and their own reach to the large pool of customer base. And as per our analysis, all these the 72 partners I'm referring to, this comprising of MFD digital platform, RIA platform, which includes the Zerodha Bank, and such platform aggregate numbers that there in the industry is about 68,500 crores, out of which we have close to about 8 to 8.5%. We used to have roughly about 10.5% market share, and given the fact more players also come in, it appears that it now gone about roughly about 8.5% kind of market that we have. So I think clearly our aim is to actually ensure that one, we work with them very closely And wherever we have to get our products to be part of the recommendation list, that's something which we do. And second is how we can actually work with them closely in creating a new features that we as the funders have been quite engaged for right from the early time of the inception. And that's something will also help us in having our healthy market share coming from the segment. As you know, this RIA platform, especially if it is a formula-driven a platform, will go by who is of course performing best. I leave aside that. I think the large pool of such platform, the relation that we have built, and hopefully it will help us in adding new customer base. In fact, the total size I just mentioned about it is about 60,000 crores. In that is something which will I think keep growing in a smaller ticket size or maybe the millennials. That's where we see it.
Sure. So, and sir, do you see any behavioral differences from the AUM which is coming from this channel? Do these investors churn their AUM quickly, or they continue to how they are behaving similar to our offline channel? That is one point. And second is, sir, how do we think about the profitability of the inflow that is coming from this channel?
Yeah. See, with respect to behavior, and it is clearly it varies from platform to platform. And one such behavior exists is actually the people prefer to put low ticket money, 1,000 rupees, 1,500 rupees, or 2,000 rupees. That's why if you look at this channel, SIP average ticket size would be in the range of about 1,200, 1,500 rupees. And these channels also want 100 rupees kind of transactions at Paytm. They have introduced 100 rupees also transactions. We have done this not looking at the profitability of this product, but end of the day, we have a duty to serve large pool of small investors, and eventually the small investors, like what happened in kind of Jandan account opening which the government of India did, initially with zero balance, eventually the balance that is there in that account is I think quite large. We believe that's the way to build our customer base. That's something we have agreed to this platform. Therefore, the cost and profitability may not be very, very large. At the same time, new customer acquisition that is there is something which should help in increase the customer base from the segment. But having said that, the other behavior, of course, is there are a lot of people who actually come for some time, and they also have tendency to actually move away. Therefore, the persistency rate between the mutual fund distributors and this kind of platform, I would assume the handheld advice that provided by the distribution community, the persistence would be a lot higher compared to the digital platform this point of time, because there is a tendency for investors who come to the digital platform to be very quick, actually even taking their profit away. That's something at this point of time I see as a broad trend.
Sure, sir. Yeah, sir. That's it from my side, sir. Thank you.
Yeah, thanks, Ritesh.
Thank you very much. Ladies and gentlemen, due to time constraints, that was our last question for today. I now hand over the conference to Mr. A. Balasubramanian for closing comments. Over to you, sir. Participants, I request you all to please stay connected. We have lost the line for the management. Participants, apologies for the delay. We have the management line reconnected. Yes, Mr. Balasubramanian, for your closing comments. Over to you.
Yeah. Thank you very much, ladies and gentlemen, for tuning in and had a detailed, good, engaging discussion. With this, we conclude our Q2FY22 earnings call. Do feel free to reach out in case of any unanswered or additional questions. You can get in touch with our IR, Mr. Prakash Bogle, whose email address has already been shared with everyone. I wish you a very happy and prosperous Diwali, and stay safe and stay healthy. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Aditya Birla SunLife Asset Management, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your lines.